Retirement Plan Accounting, A Sponsor's Perspective, was a live webinar that was originally produced on Tuesday, May 24th, 2016. The presenters for this presentation were Dan Sturm, Shalane Cohen, and Danielle Ginter, all with McConley and Asbury. Enjoy this webinar recap and visit us online at www.macpas.com for more information about our future events and upcoming presentations.
All right, everybody. Thanks for joining us today for the Retirement Plan Accounting webinar. As Tyler mentioned, I'm Dan Sturm. I'm a principal with McConley and Asbury, and I help lead the Employee Benefit Plan practice. I'm joined by Shalane Cohen, Senior Manager, also a key member of our Employee Benefit Plan audit practice, and Danielle Ginter, also a key member and Senior Manager in our Employee Benefit Plan practice. That being said, a few objectives I want to go over, make sure everyone gets what they want and hope to get out of the presentation. We want to help you gain an understanding of new accounting pronouncements that directly impact employee benefit plan accounting. And for the first time in a couple years, we actually have a couple new pronouncements to go through, a couple new substantial changes that should make everyone's life a little bit easier with benefit plans. We also want to help you gain an understanding of updates to regulations that relate specifically to 401k and pension plans. We want to provide tools to you to help you select a qualified plan auditor if you do not already have one. And we also want to help you understand the common audit pitfalls, primarily from the perspective of the Department of Labor. Lastly, we want to help through a couple case examples, help you identify ways to mitigate your risk of any costly mistakes in administering your plans. And with that, we are going to go to our first polling question. And the first polling question is, what is your role in the employee benefit plan process? You're either a sponsor with Human Resources, sponsor with Finance, Accounting, or other. You're a plan auditor or a CPA firm, or you're some other service provider. And we just want to use this polling question just to gauge our audience and make sure we gear each of the slides in our presentation to the appropriate audience. All right, great. Looks like we have a good mix of people that I would expect on the call. So hopefully each of the groups of people that are represented on the call, we can provide a little bit of information and some updates for you to help you with your benefit plans. With that, I'm going to turn it over to Shalane to present the accounting standards update.
Good afternoon. I am going to go through two new accounting standards updates that were issued in 2015. Over the years, I feel like when new accounting standards updates come out, it's not always welcomed because they usually require more work for everyone involved, adding to your financial statements. And for once, they have some things that make sense and trim down the disclosures in the financial statements. So we're going to go through these real quick. The first one is ASU 2015-07. And this update applies and relates to a plan that has investments in entities that calculate net asset value as a practical expedient. And this clarifies how investments valued using this method within the fair value hierarchy should be classified. Just to be clear, this would not include mutual funds. The reason being is that mutual funds are considered to have a fair value that's readily available. So with this ASU, the purpose of it is to get rid of some of the diversity that's being practiced among different plans and to make sure everyone's on the same page, because that wasn't the case before. And what this does is it allows these investments valued at NAV to not have to be classified within the fair value hierarchy table. Historically, they've had to be classified as level 1, 2, or 3, and now it eliminates that decision-making process. While it's not technically effective until years beginning after December 15, 2015, early adoption is permitted and oftentimes encouraged depending on what investments you have in your plan.
Shalane, with these new standards that you're talking about, and I think starting off with this one, can can you just give some background to our audience as to why all this happened and why these are being issued now? What's the general reason that after a couple years of expanding disclosures, now all of a sudden they seem to be retracted?
I think a lot of these requirements, specifically in fair value disclosures, was added for a lot of not just benefit plans, but for entities with hard to value investments, and all of this stuff was coming out to give more clarity, but it wasn't as effective or valuable for benefit plans. So I think they're finally retracting it to make things a little simpler and a little more user-friendly for those that are actually reading the statements.
Yeah, and I think from our experience, a lot of this information, I don't think our clients or the participants in the plan were even using anyway. So I think it really makes sense.
And I mean, and if they were, they can continue to show it for one more year. This next slide will hopefully give you a tangible example to reference for those of you that are preparing financial statements. And what this shows is previously you would have seen investments, for example, like a CCT if it's valued at NAV, as level 2 or 3, and it would be listed up there with your common stock and mutual funds as a separate line. Well, now, since we're saying that it's not leveled, it goes in a separate line, all on its own, all of your investments that are measured at net asset value. And they're only listed in total, as you can see in that total column, rather than being broken out into level 1, 2, or 3 like the other types of investments are. And as I mentioned earlier, there was some discrepancy between practice, and sometimes they were reporting it as level 2, sometimes it was level 3, and there just wasn't really a consistency. So now there's no level, and it just goes in the total. And it's needed so that you can tie the total investments at fair value. If you look in the bottom right-hand corner, the $7,397,000 would tie to the face of your statement of net assets available for benefits. The next big accounting standard update is 2015-12. And this one is composed of 3 parts, and all in all, it simplifies or eliminates some of the financial statement reporting and disclosures that are required. It has the same effective date as the last ASU, years beginning after December 15, 2015, and again, early adoption is permitted and encouraged.
Shalane, these all sound great to me. Can you think of any reason why someone would not want to adopt these?
I really can't think of one offhand. It's really pretty beneficial to all those, like whether you're the one preparing the financial statements or whether you're the one auditing the financial statements. I really can't think of one. The first one is part 1, and this would only be applicable if, let's move to the next slide. The first one is related to fully benefit responsive investment contracts. So this only applies if you have investments of this type. So if you have a contract, oftentimes with an insurance company that you've evaluated as fully benefit responsive in the past, you'll want to pay close attention to this one. So previously, you would have had an adjustment on your statement of net assets showing an adjustment from fair value to contract value. That will go away, and I'll show an example of what that looks like as well. Also, these fully benefit responsive investment contracts, which I'm going to call GICs going forward because that's quite a mouthful, they're no longer required in the fair value table in the note disclosures. And because they're not required in that table, you also don't have to have a reconciliation of beginning and ending values for the plan year. And I think one of the ones that I find most beneficial is the no longer are there requirements to disclose the quantitative inputs to the valuation. This information sometimes was kind of hard to get from whoever was providing the contract, and it required quite a bit of digging sometimes from whoever was responsible for that. So I think that will really be helpful as well. And just to be clear, this does not apply to CCTs and stable value funds. This is only for direct investments in insurance contracts that the plan has. So if you have CCTs or stable value funds, they would more fall under the previous ASU that I discussed. So here is an example of a statement of net assets, and you'll see that now there isn't just a line of investments at fair value. Now you have investments at fair value and then investments at contract value, which would be your GICs that are now reported as contract value. And then down below at the bottom, previously we had investments at fair value and then essentially net assets available for benefits at contract value. And then between there, an adjustment. That will no longer be shown at all because those adjustments will all be shown up in the top.
Yeah, and I think it's important to note, even with this change in presentation, that the net assets at the bottom of the schedule don't change. So it's really just reclassifying and changing the presentation up above the total net asset balance.
Mm-hmm. Here's an example of some of the disclosures that previously would have been in. So within your fair value note, you would have had a description of how the guaranteed investment contract was valued at fair value. Since it's no longer considered at fair value, you no longer disclose that. So that disclosure can be omitted. In addition, you'll see there's a red strike through the guaranteed investment contracts that were previously recorded in the fair value table. So that gets struck out as well. And then lastly, here is the roll forward from the beginning of the year to the end of year. And this is always required for level 3 assets, which is what a GIC is typically classified as. So before it was required, and that's no longer necessary, along with the quantitative disclosures, an example which you can see at the very bottom there. So that was part 1. That's really only applicable if you have a guaranteed investment contract. Part 2, I feel like, is probably going to be the most pervasive as far as its impact across most plans.
I think it's important to note here as well, Shalane, a sponsor or an accounting department can adopt part 1, 2, or 3. They don't necessarily have to adopt all 3 parts, but if a part is adopted, it needs to be adopted in full.
Yeah. And I think on top of that, just a reminder that if you are adopting any of these early, you would just want to make sure that you disclose what parts of this you're adopting in the current year and apply that both to this current year and retrospectively to 2014 as well. Okay, so here in part 2, this has to do with all of your disclosures related to investments. So in the past, what we've seen is this fair value table kind of blow up. And it was requiring mutual funds to be broken out by different classifications, like what they're invested in, and to try and get at the risk. That's no longer required. Now you just have to disclose them by the nature. So your mutual funds, your common stocks, collective trust funds, etc. So that should get rid of a lot of the disaggregation that was needed before. And as you can see, self-directed brokerage accounts are one general type now. One other disclosure, which I'm happy to see go, is any investments that make up more than 5% of your net assets available for benefits needed to be called out in the notes, which any plan that has assets at the end of the year has a supplemental schedule that shows detail of every single investment. So if someone wanted to see that, they could easily calculate with that information that you see in the supplemental schedule. So this really, I can't imagine any reason that this would be missed. Also, currently, you show net appreciation to depreciation in your investments on the financial statements, and then within the notes, you're required to disaggregate that by your mutual funds, stocks, bonds, where you're seeing both growth or declining. That is no longer required. Now you just have to show it in the aggregate, and that's sufficient. And then lastly for this part, historically, if you had an investment that was measured at NAV, you had to disclose the investment strategy. That requirement is also going away. And the caveat being that the investment has to be a direct filing entity that files a Form 5500. And the easiest way to identify that is looking at your Schedule D on your Form 5500 and seeing if they're listed. And if they're listed there, then you don't need to disclose their investment strategy in your financial statements like you would have previously. So again, I'm going to go through these, show you examples. You'll have them for your reference. This first one shows the table with 5% or more assets, and then also the disaggregation of the net appreciation, depreciation that's no longer necessary. And then that was it. Okay, so part 3, this I think will apply to very few plans, at least in my experience. And this only applies if you have a fiscal year end that doesn't coincide with a month end. If you do happen to be one of those plans, it does allow you to choose or to measure using a month-end date that's closest to your plan's fiscal year end. So I think this will be really helpful for the few plans that it does impact, but don't be surprised if it doesn't impact your. I mean, we see mostly month-end financial statements. So I think that's it. Please think about that, and if you have any questions, please pop them up, and we'll either answer them as we go or at the end.
So our next update is going to be a regulations update, and I think this brings us to our next polling question. Do you or have you applied for an IRS determination letter for your plan? Yes, no, I have a prototype plan, don't apply for a separate letter, or I have no idea. Okay. So IRS determination letters have been kind of a hot topic the last couple years, so I'm curious to see what our answers end up being. Okay, 21% yes, 31% no, I have a prototype plan, and 48% I have no idea. So hopefully these next few slides might help those who don't have an idea right now, and for others, they'd be giving you a really good update. Okay, so IRS determination letters. So a lot of plans, as we could see in our polling question, have what would be called like a prototype plan, where they essentially adopt a pre-approved plan document through a company such as Fidelity or Vanguard or Schwab. And then these companies would then have to apply for an IRS determination letter every 6 years. And then the adopting plan sponsors would then have a certain period of time to sign a restated plan document. Typically, it's about 2 years. So the most recent deadline was April 30th, 2016. So I would expect for those plan sponsors that have these prototype plans, in the last year or so, your third-party administrator would have had you sign a restated plan document. Now, if you're listening to this and you know you have a prototype plan and you're like, this doesn't sound familiar, don't panic. The IRS has expected that maybe some people will have to correct this, and they've given a couple of options. One is you can go through the voluntary compliance program, and you would essentially adopt the restated plan document, you'd fill out a VCP submission, you'd pay the penalty. The other new option also allows like a financial institution or a service provider, similar to the ones we mentioned already, like Fidelity, Vanguard, or Schwab, to request a closing agreement on their behalf. And the thought process behind this one is, say those companies have several different clients that maybe didn't adopt in time, they could do this closing agreement for all of them at the same time.
So Danielle, we had some people on there that weren't sure if they had an IRS determination letter. Can you give an example of a plan or a plan type maybe that would have a non-prototype plan so that they might be able to identify if they have that?
Sure. So they would then most likely have an individually designed plan. And a lot of times you see those with ESOPs, or say you have a 401k with a lot of different idiosyncrasies where you wouldn't be able to adopt the prototype plan. But we're going to talk about individually designed plans in a little bit.
And I think probably from a more general perspective, especially those that might not be sure if they have a a determination letter, what is the benefit of actually having a determination letter, regardless if it's from a prototype plan or other?
Okay, so it allows employers to deduct their employer contributions up to the applicable limits. It also allows plan participants to contribute to the plan tax deferred, and then it allows those contributions to grow within the plan tax deferred until it's time for you to take a distribution. And then I also have listed here 403B IRS determination letters. So historically, you haven't been able to get an IRS determination letter for a 403B plan. In 2013, the IRS started to allow IRS determination letter applications for prototype plans for 403Bs. They're still not allowing them for individually designed plans, and I don't anticipate that changing. I'll talk about that a little bit more in a second. But again, like, why would you want to consider maybe a prototype plan and adopting this IRS determination letter? It gives you the peace of mind of knowing that your plan document, generally speaking, is designed within the legal guidelines. Okay, so individually designed plans typically have had a cycle to apply for these IRS determination letters. So we said prototype plans was every 6 years. For individually designed plans, it was every 5 years. Well, the IRS has discovered they just don't have the resources or the time to give these applications the time that they deserve. So they are essentially eliminating the 5-year cycle for individually designed plans starting in 2017, which will mean you can only apply for an IRS determination letter for these plans at the initial plan qualification and then upon plan termination. So, most plan sponsors are going to be disappointed about this because you're losing that peace of mind of knowing every 5 years I'm going through this process and I'm essentially being told that my plan document is in compliance with IRS regulations and legal requirements. So the IRS and the Department of Treasury understand that this is going to be a big adjustment for plan sponsors, so they're trying to think of ways to make things easier for them to stay in compliance. So a couple of the things they're doing is they're providing model amendments on the IRS website that you can use for the sample language. They're also not requiring certain plan provisions or amendments if it's not relevant to the plan. And they're also looking at their pre-approved prototype plan, and they've now said that they're going to expand this to ESOPs starting in 2017.
So let's say for a minute that the IRS isn't super on top of this and doesn't get information out really quickly so that they can address this. Can you think of anything that the plan should be doing in the meantime?
So if it were me, even if it's a prototype plan, but especially for an individually designed plan, I would be making sure that as a plan sponsor, you're meeting with your service providers, if not on an annual basis, on a semi-annual basis, especially either an ERISA attorney or your third-party administrator, and really making sure that you're going through that plan document and you're not missing anything. Okay, so Form 5500 changes for 2015. Plan sponsors may have noticed that they were getting some additional questions, unique questions this year that maybe they haven't gotten in the past. And essentially this has come from, in 2014, the IRS announced some changes to the Form 5500 series that is going to help them monitor plan compliance. And these questions, you'd be able to see them if you had a 2015 Form 5500, you'd be able to see them on Schedule H, Schedule I, and Schedule R. Well, when 5500 preparers and service providers heard about these changes, they thought it was a lot to ask for in a short period of time. So what the IRS did was they said that it was optional for 2015 to fill out these compliance questions. And then they also released an FAQ document to serve as a guideline for people. And the one thing that to me stands out about this is just as a reminder that the DOL and the IRS really use these questions to essentially look for red flags if there's anything going wrong with the plan. So it's really important for plan sponsors to really review your 5500 and make sure that it's accurate, because you don't want to have your 5500 flagged by the DOL or IRS for a keying error or for not reviewing it properly. And just to remember that if it is if you do get an audit request or an inquiry, they're not going to go to the 5500 preparer. They're going to go directly to you. So it's just really important for you to really review your 5500 in detail. And the only thing else I wanted to mention as far as 5500 is Congress has repealed a change in the law that would have given plans another month with the extension that would have started in 2016. So essentially what this means is there's no change if you have a 12/31 year end. After the extension, your due date is still October 15th. So the Department of Labor Conflict of Interest Rule, I thought this was really interesting. So a lot of the laws and regulations around retirement plans are from 1975, and the DOL says that they have not been meaningfully changed until now with this DOL Conflict of Interest Rule. And essentially what this rule says is the conflict of interest final rule and related exemptions will protect investors by requiring all who provide retirement investment advice to plans and IRAs to abide by a fiduciary standard, putting their clients' best interests before their own profits. So, I would hope that most investment advisors were already doing this. The biggest change with this is now they're legally required to do so.
From a sponsor's perspective, for purposes of this webinar, is there something our plan sponsors should be doing as a result of this rule?
So this mainly applies to investment advisors and not to plan sponsors, but I would think it would be a fair question for plan sponsors to ask their investment advisors what type of impact, if any, it's going to have on their service agreement. And it's just important for plan sponsors to understand that this doesn't change, that they still need to make sure that they're understanding the services and the fees that their investment advisors are charging. And I think there's still going to be more to come on this because from everything I was reading, given that this impact isn't effective until 2017 and 2018, most investment advisors are still trying to figure out what impact it's going to have on them. So I think we'll see more to come on this.
And I think it still follows everything we've seen in the past 5 or 10 years, at least since I've been heavily involved with benefit plans, that it's really looking out for not only the plans, but specifically the participants, to making sure the participants come first, and this just seems to follow suit with that.
No, absolutely. The DOL's main concern is protecting plan participants.
The next area we're going to touch on is missed deferrals. So to paint you a picture of what we're talking about here, this would be if a participant elects to defer 10% of their payroll and go into their 401k plan, and for whatever reason it gets missed, and for 2 months nothing is getting withheld from the employee's pay to go into their 401k. So they're essentially missing the opportunity to put funds into their 401k that they wanted to.
So we're essentially focused on the missed opportunity. So we're not referring to a participant's contributions weren't stolen. We're not talking about that. This specifically refers to, I signed up on January 1st. I wanted 10% withheld from my paycheck. It didn't happen until March 1st. And so I missed 3 months of contributions to my 401k plan when the market grew at 20%.
Yep.
Okay.
Exactly. So the IRS has an employee plans compliance resolution system that allows them to correct the plan sponsor to correct mistakes like this. And we have the link there in the slides as well. So they've given some guidance. And before, the process was that the plan sponsor had to make a qualified non-elective contribution of 50% of the amount that the participant lost the opportunity on. So let's say that they wanted to defer 10%. The plan sponsor has to make a contribution of 5% into the plan on behalf of that participant. So what this new guidance is saying is that now there's kind of 2 buckets that you can fall under related to the employee deferrals. If you meet certain criteria, you are allowed to not make any corrective contributions from the employee's deferral. So in order to do so, the employer has to discover it within 3 months of the first failure and correct it by that time. Or if the employee discovered it and notified the plan sponsor, they have until the last day of the following month. So if you meet the earlier of those, then you don't need to make a corrective contribution. However, if you don't meet that, then you may have to make a 25% corrective contribution if if the employer identifies it and they don't fix it until or prior to the last day of the second plan year, which quite frankly is a huge window of opportunity to be caught and to be corrected. Or if, in the same instances before, you correct it within the second month that the employee identified it. So it's giving you a little bit of grace and should encourage you to correct it on your own. So that refers to the employee contribution, but then there is two other requirements. And one is that a written notice is sent to the affected employees within 45 days after the correction was made. And then second, similar to missing out on the opportunity before, since they missed out on the opportunity, they also missed out on the match or any profit share that they would have had they made that deferral. So this requires the employer to make a contribution of that matching plus any earnings that would have happened between the time it should have been deferred and the time it was corrected.
You know, Shalene, I heard the IRS speak about this last year, and it seemed to really be driven from them wanting plan sponsors to strongly consider auto enrollment, but plan sponsors were concerned about how easy it might be to miss like one or two deferrals because of the auto enrollment and the timing. And that seemed to really be what drove the IRS's change to these corrective contributions.
Yeah, I mean, I think the important point of this as well is I think they're trying, they being the DOL, the IRS, are trying to make things a little bit more simplistic for plan sponsors in situations like this, because I think we all recognize these things happen. When you're talking large companies and even small companies, mistakes happen, whether it be a payroll error somewhere else. These things happen. So they wanted to provide some more clarity on how do you deal with it. So I think the point with this is if you realize or a participant brings to your attention or you realize you missed a deferral that should have happened, that there is new guidance out there, and what you may not have picked up everything exactly you need to know from our presentation, just know the guidance is out there, and if it's something we can help you with or address a question, we'd be glad to do so. But the guidance is out there to help you and hopefully make the participant whole. Next section is selecting a plan auditor and audit pitfalls, and I think we also have our next polling question. And that question is, did you receive correspondence from the DOL in December regarding the selection of an auditor for your plan? And that would have just been a letter directly from the Department of Labor.
I do believe they were also sending emails. I know some of my clients received both letters and an email as well. I'm just waiting for people to answer here.
Yeah, I think based on our audience mix, I think these are probably the results I would expect. The no answers somewhat surprised me unless you are not a plan sponsor on this call, because as indicated on the first bullet of my next slide and emphasized by a recent discussion I had with the DOL, letters were sent out based on the database of 5500s. And basically what the DOL did was identify all the plans that required audits and identified those plan sponsors and sent out letters to them. And really the purpose, they wanted to highlight the importance of each plan that required an audit to have a qualified and experienced CPA firm doing that audit. And we'll get into some of the reasons why in the slides to follow. But it's been a hot topic at the DOL. And so this letter was sent out really to highlight there is an issue here, and they want plan sponsors to be aware of it. The letter really urged care in selecting an auditor, so don't just go for the lowest priced firm. Don't view it as just a service you need to get over with, because there's been problems, and we'll highlight a few of those. And whether it's because someone went with the lowest fee or other factors, the fact of the matter is not every CPA firm out there is qualified to audit a benefit plan, and so it takes unique requirements. It takes unique training, and the DOL understands that. So that's a really big driver for this letter going out. Really, what the letter highlights is it not only does it urge you to use CARE, but it also provides some factors in how you make that selection. The first bullet, number of plans audited by a CPA firm. A lot of the DOL findings that they've issued have come with the firms that may audit one or two benefit plans. It's not to say that there's not a good firm out there that can audit one or two benefit plans, but the point is, if a firm only does one or two benefit plans, there's enough uniqueness to these benefit plans to where that firm may miss things. So it's a high indicator that it could be a problem. Also, suggest you talk to your CPA firm or your prospective CPA firm about the extent of CPA firm trainings. That's a good indicator if the firm is not being trained properly. There's enough changes, as you see in this highly summarized presentation. There's enough changes from year to year that staff and team and partners should all be trained at least annually on the benefit plans. Also, inquire about the status of a firm's CPA license. And again, I would expect most of the firms or the people that they're dealing with on this call that their firm is in active status. But again, it's a good question to ask because that could change from year to year. Next is whether the firm has been subjected to DOL findings or referrals. I just recently listened to the DOL speak in another presentation on benefit plans, and I think they're still amazed by the amount of plan sponsors that continue to work with firms that have had problems in their benefit plan audits in the past and that have had findings in the past. And I don't have a reason why a sponsor would stick with that particular firm, but I know from the DOL's perspective, they continue to be amazed at the amount of sponsors that stick with a firm that has continued problems and may subject that sponsor to fines. Next is the results of a recent CPA peer review. Obviously, as an audit firm and a firm providing audits, it must go through a peer review process. Part of that is looking at benefit plans if that firm audits benefit plans. So results of that peer review is a key to understanding what you should be looking at.
So Dan, I can see a lot of these items to consider being part of a request for proposal type situation when someone's looking to change or at least look at what other options are out there for auditors. Is there a certain time frame that even if you're not looking to change auditors that you should check in with your current auditors to make sure that none of these items have changed since you originally engaged them?
If I'm a plan sponsor and I'm in a plan sponsor's shoes, I don't think it's unreasonable to ask each year upon engagement. Maybe that's too frequently, but I don't think it's unreasonable to at least ask those questions. Ultimately, regardless if the CPA firm does a bad job, the DOL is coming back to the plan sponsor. They're holding you accountable, just like they're holding the sponsor accountable if investment selections are not appropriate. Ultimately, the fiduciary responsibility of the sponsor, there's an expectation that there's a certain level of diligence that you provide in selecting an auditor. So if I'm a sponsor and I have that level of responsibility on me, I'm probably asking, maybe not all these questions, but I'm probably asking some of these questions, at least on an annual basis.
I would just add, one more thing, that you had mentioned like how industry specific it is and how you really have to have specialized knowledge of benefit plans and stuff. So I think something from a plan sponsor to consider is if you're in charge, like if you get other audit services, so maybe your company is audited or gets a review or something like that, those same people that do that service may not have that expertise. So you just want to make sure, like, your teams could be different, or it's always good to talk to them first, but just don't be surprised if the same people that you're used to seeing on site aren't the ones who are working on your benefit plan, because there may be other people that are more experienced in that area. So just something to consider.
No, I agree. Of all the industries that I work in, this is probably one of the most unique. I mean, you can switch from manufacturing to construction, they have unique accounting requirements and presentation matters, but when we're auditing a benefit plan and when we're looking at a benefit plan, it's not as much, while presentation is important, a lot of our work is driven towards compliance.
Yep.
And is the plan sponsor complying with certain things? Even though it's not a compliance audit, a lot of what we're doing is driven towards that. So, and I think we've already kind of indicated this, but a quality audit will help a plan administrator carry out its legal responsibility and complete an annual return and report each year. So it's just it's one part of the process, one important part of the process that sponsors should be aware of. And we provided a couple links that are public information that we want to share with you if you are considering selecting an auditor, or even if you have questions for us, by all means use these questions and answers to help you do your job better. When we were made aware that the letter went out, one of the things we did was in our newsletter that's made public on our website, and we sent it to our clients, we wanted to kind of respond to some of the questions raised by the DOL from a Conley and Asbury perspective. And on this slide, I wanted to highlight some of those things that we've talked about. I'll be very brief with this, but we do have a dedicated employee benefit plan team, so we have a group of people, including the three of us on this presentation. I know I can speak for us. We've worked together for about 10 years on benefit plans. We have other partners in our segment that have worked on benefit plans for 10 plus years, and we have a very consistent team of people. So I consider it a key part of our firm, and we spend a lot of time on training and working with benefit plans. We are also a member of the AICPA Employee Benefit Plan Audit Quality Center. What that means to you, the listeners, is we're just held to a higher standard. So we chose to be a member of this quality center. We adhere to different requirements to make sure that we're trained a little bit more, and our engagements go through a little bit more of a process. We audit 75 plus employee benefit plans, and that practice continues to grow. During my time here, through the help of many people, we've been able to triple that practice in size in the past 10 years. We look at defined contributions, defined contribution plans, defined benefit, health and welfare, ESOP, and 403B plan. As I mentioned, our entire team is trained at least annually. Several members of our team attend local and national benefit plan conferences. Our firm license is active, and we've not been subject to any DOL findings or referrals. I can say a couple of our engagements have been picked by the DOL. We've not had any findings or questions come out of those engagements, and we have a pass on our recent peer review report. And the intent of that really is just to respond to those that may have not seen our newsletter, but for all the clients we have on the call, to respond directly to that DOL letter that went out. Next slide here, I think, highlights, it flows nicely into why does the DOL care? Why did they send this letter out? What was happening to trigger them to say we need to send a letter to every plan sponsor to make sure that they're focusing on their auditor selection? And I think bullet number 1 highlights everything. I've seen studies over the past 5+ years from the DOL. Audits continue to become more deficient in their eyes. So across the board, they're just seeing more and more findings of things that they just don't like what they're seeing with the benefit plans, quite honestly. That could be something as simple as documentation in a benefit plan audit. They don't like how things are documented. But it's also a lot of items that are compliance driven that we've talked about. So there's certain compliance procedures that you would not perform in a typical financial statement audit, but that we absolutely have to do in a benefit plan audit. And a lot of that's driven by ERISA. And so the DOL, when they open up our work papers, that's what they're looking for, or open up any firm's work paper. So they're looking for those compliance procedures, sampling, again, looking out for the participants. So if a firm's not doing those appropriate compliance procedures, it's almost immediately results in a deficient audit. One of the other things that they pointed out recently is over-reliance on the limited scope exception. Again, with benefit plans and the limited scope audit reports, it's kind of unique to this industry, but it was set for ERISA for very certain reasons, but there's been over-reliance or improper use of that limited scope report. Recent study done by the DOL, 4 of 10 audits failed to meet professional standards for any number of reasons, including the ones I just discussed. They actually referred 28 CPAs to state boards. And the point of that is, in those cases, I think the audits were so bad that they wanted to make sure those particular practitioners weren't going to be working on benefit plans going forward or auditing benefit plans going forward. For the sponsors on the call, I will highlight the third bullet. This is absolutely true. There is a potential $50,000 penalty for deficient audits, and I will highlight that $50,000 is not going to the audit firm. That is a penalty to the plan sponsor. And I used to think that, okay, that's just the far end of the spectrum. That probably wouldn't happen. But then I was talking to a peer that also works in benefit plans that was helping another firm out that had reached out to him that apparently had a very deficient audit, that his client did receive a $50,000 letter in the mail for a deficient audit. So ultimately that amount was reduced, but it was only reduced once attorneys were involved and once the sponsor spent additional resources working with other firms to kind of bring everything up to par. But the reality is that $50,000 penalty is realistic. It can happen, which highlights the need why you should have a qualified auditor, because while the audit firm may have done a terrible job, ultimately it falls back on the sponsor. One of the other things, kind of off topic, but again from a DOL perspective, from a DOL update, in recent speeches I've heard from them, there's a continued and emphasized focus on cybersecurity. They are continuing to focus on that, and so while you may not see a whole lot about that now, I fully expect in the next 5 years to hear a lot more about cybersecurity and security of participant data when it comes to employee benefit plans, just due to the amount of information available for participants at the plan level that's being exchanged, whether it be through a service provider, an accounting firm. So I expect similar things to what you see for healthcare data protection. So with that being said, if you have any questions over your security of data being exchanged with your participant information, I don't think it's ever too soon to start looking into that.
Especially, Dan, a lot of the files we get have social security numbers, names, date of birth, date of hires on it, so I can definitely see why the DOL is focusing on that.
Yeah, which brings us to our last section. What we like to do here, we have 2 criminal cases, and we pull these straight from the DOL website, so they're available to the public, but it's things we like to use, not to show you this case in particular, but to use these cases to maybe take questions back to your organization and say, okay, do we have everything we need so this doesn't happen to us? And in this specific case, we have a produce distributor embezzling money from a 401k plan, essentially. And this one's a little bit more complicated because there was collusion. So the owner of the company and trustee outside the organization basically worked together to pull money from the plan. So they, all told, there was about $800,000 moved from the 401k plan to corporate accounts in 3 separate transactions, as you'll see. So basically what they did was almost deplete the 401k plan. And what I see with this is there was reasons. It wasn't just to go buy a big fancy yacht or something like that you might see on TV. This actually appears to be a case where maybe the company had cash flow problems. So they were using that money to cash flow the company when they're using the money to buy produce. Now, they did use for personal expenses, but it sounds like in this case the company was using it to cash flow. And just like most frauds, I anticipate that probably what happened here is it probably started out as we're just going to borrow this money, we'll pay it back once things get rolling. But I think the point to note is this is not company money at all. It cannot be used for cash flow, should never be used for cash flow, and if it is, I very well could end up being a case like this that we talk about. This was done through collusion, so this would have been very hard to detect. But basically, there was investment statements for employees and participants that were created with false information. So if a participant had $10,000 in their account, and through stealing this money, they had $1,000, the participant was still receiving a statement that said 10, so they had no idea. And obviously, if they're a younger person, they're not trying to access that money. Mm-hmm. So this could go on for years without being detected. Last bullet point here, I won't read verbatim, but basically the DOL is saying what we've said all along. They're going to have no patience or tolerance for a situation like this. And so if you're caught stealing from a participant's money, they're going to do as much as they can to the extent that the law allows to prosecute people. So I guess with that being said, and I know we're coming up here running low on time, but I would have a question for Danielle or Shalane. With a situation like this, what could have been done to prevent this? If I'm a sponsor on the other end, how would I prevent something like this from happening?
Well, in this case, it seems like this one person had a lot of control. So I would say, especially on like the disbursement side, as funds are coming out of the plan, to have some type of control that ensures that a second set of eyes, other than that one person who's responsible for doing all of the transaction and providing participant statements and all of that thing, that someone else is reviewing those transactions before they actually occur or approving them through some form, whether that's electronic or a formal sign-off.
It's hard when you have an owner and a trustee working together to catch things, but maybe they could have also had an investment committee or a retirement committee where they had a board member and an employee on it, someone else who might have questioned something unusual on the plan statements.
I think with that, we have one more case to go through. We'll go through this pretty quickly so we can make sure we wrap up on time.
So essentially what happened with this ESOP case is the DOL filed a complaint basically saying that the owners of the company inflated the fair value of the stock that the ESOP purchased from the company. And they did that so that the company was in financial distress, so they used that extra money to help bail the company out. And essentially the judgment went against the company, and they ordered the company and the CEO to return $1.1 million to the company's ESOP for losses plus $220,000 in civil money penalties. And the defendants are also barred from being a fiduciary for any other plan. And the regional director, Johnson of EBSA, is quoted as saying, "Employee stock ownership plans are intended to promote employee ownership and fund employees' retirements, not to bail out a plan sponsor experiencing financial distress." So just a quick question for Dan and Shalane. When you hear this case, can you think of anything in an audit that might have been a red flag to you?
I think for me, maybe not necessarily just in an audit, but I think if I'm running a plan and I don't know everything I should about the service provider that's valuing my company. So both from an audit and a sponsor perspective, I'd want to be comfortable that the person valuing the company and valuing the stock are qualified to do so. And I know there's audit standards that require us as auditors to assess that qualification. But as a fiduciary to the plan, we don't want to just pick any person that appears to have the qualifications to value the stock, because the result could be something like this, that if it's valued improperly, it could end up resulting in penalties to the company, because it may not have been intentional. It may just been poor service in valuing that stock, and maybe the person wasn't qualified. So ultimately, just like the other situations, the company is the one on the hook to pay the money. And it could result in an example like this with the CEO having to pay back money that maybe it was not intentional, that the stock was valued improperly. Maybe it was just not done properly, which results in this person having to pay the money back.
You know, typically with ESOPs, they're required to get a valuation every year, but I think this case just highlights how important that initial year is and ensuring that that's an accurate reflection of the valuation of the company. So really making sure that all of the assumptions that are used for that valuation are accurate and reasonable, and that you're not all of a sudden going to see a decrease in the stock value over the next 10 years.
And that's it for our presentation. Is there any questions from the audience?
It looks like we have just a couple minutes, so we're going to look at one question that we had, and that is that we had talked earlier about some of the areas that the DOL is focusing on, and this question is, what other areas does the DOL seem focused on?
Well, I think the DOL, like we had mentioned, they're very concerned with plan participants. So they're always concerned about the timeliness of employee deferrals being contributed to the plan. They're also very concerned with hardship withdrawals and making sure that they're being done in compliance with plan documents. And, just as far as the IRS, over the last couple of years, the IRS has been really focused on what internal controls are in place at plan sponsors. So those are some of the things that I've seen.
With that, I want to thank everyone for joining us today. If you have any questions, our email addresses and contact information are on this screen. By all means, reach out and let us know. Thank you.
Thank you once again for joining us for this presentation produced by McConley and Asbury. We hope you join us for our upcoming events. You can stay up to date with news and learn more about our upcoming events by visiting us at www.macpas.com. Thanks again, and have a great day.